Hello, everyone, and welcome to another episode of Flipping Out. This is going to be a solo cast, and today I'm going to go over lots of different data. Really want to kind of show you guys what's going on in the real estate market right now so you could see what's happening currently and where things are shifting for 2023 and even into 2024. We have very, very interesting times. I mean, 2022 was whirlwinds. We started off with like a banshee, and mortgage rates started around 3% or even slightly below in the beginning of January of 2022. And the market was on fire, and we had our lowest inventory in history of the country. So we had such low inventory. And this year, we still have incredibly low inventory, although it's almost double what we had last year at the same point. It's still incredibly low and way, way, way below the normal average inventory. And that is creating price stability. And according to CoreLogic, they believe we maybe hit the bottom of the real estate market and are going to be trending up over the next year. Not sure I agree 100% with that. I think temporarily we have hit our bottom temporarily. I think we're in a really good spring market here because there is such low inventory and there's so much demand, and there is decreasing mortgage rates right now going on. So this is all a big, big positive. Let's get into the CoreLogic data here and talk about that. So according to CoreLogic, we hit the bottom in February. February of 2023, prices increased 0.8%. And we did see that early demand. We started to see demand in January, and really in late December, but definitely in January, especially the middle of the month, it really started to pick up and continued in February, March, and now we're in April. And we still have good demand in certain markets. In other markets, it's slowed a bit, but it really depends about how much inventory is in any given market. And we have areas where there's much higher levels of inventory, like let's go to these tech areas. So San Francisco, Seattle's got higher inventory now, Boise, Idaho, Phoenix, Arizona, much higher in Utah right now and around Salt Lake and those markets. Higher in different markets in Texas and a couple of other smaller markets, but that's where your bigger, higher level of inventory is. Dallas is still good and strong, but anywhere there was a tech market it was a tech hub, they were hit, and that was because the NASDAQ got crushed last year, and there were massive job layoffs in the tech sector. Lots of layoffs, which affected those particular real estate markets, push up inventory either because jobs are gone, people had to relocate, get a new job, move, leave, and that increased inventory, or people just had to sell or forced to sell or turn their property into a rental if they did in fact own it. So that's what's going on last year. This year, we don't have it's still bleeding. The tech market is definitely still bleeding, but nowhere near to the level it was last year. Last year it was just crushed, and the NASDAQ has stabilized and has been better so far here in 2023. And I do expect that to rebound probably in 2024, but I do expect big job losses in retail, maybe in healthcare and in others, although there is a lot of demand in healthcare with the pandemic, obviously. But I still think you're going to have a lot of job losses in a lot of different sectors that we're going to see. Let's get back into CoreLogic here. So going up 0.8%. And CoreLogic is different than Case-Shiller Index. And I don't really take, Case-Shiller Index is good, but I believe they only look at around 19 major cities, major metro. And I don't really want to just consider those major metro areas. I want to look at the whole market in general. We really look at the whole country and get a better idea. Even though real estate is a fracture market and there are different markets that have increased drastically and other ones that have dropped pretty substantially, still want to look at everything as a whole just to have a baseline. And then we can look at each individual markets and see which markets are going to be good to target for you guys and which ones you may want to avoid, and why you may want to target those certain areas or why you may want to avoid those other areas. I can go into probably hour-long podcast about just that. And maybe that'll be something we do here in the future with some more solo casts that I'd like to do. So CoreLogic is expecting the home prices to increase between 3.7% to 4.6% from February 2023 to February 24. So while most forecasts are saying that real estate will be flat or down a little, CoreLogic's actually predicting that homes are going to be up 3.7 to 4.6, which would be fairly surprising. If you're looking at the whole entire country, we get that. That means you're going to have areas that go up 10, 15%, and other areas, of course, that go down that 10%, maybe 15%. Some already have hit those bottoms. So definitely something to keep your eye on, but CoreLogic is very, very good. And again, biggest factors, why are they coming up with this number? Well, biggest factor being supply and demand, basic macroeconomics. You have only 410,000 properties available on the market right now. And that is historically extremely low. And the prices have been dropping, the amount of real estate has been dropping over the past few weeks. And we're been kind of flat between last week and this week, but this is normally the time it's been going up. Inventory goes up. People list their properties in the spring market, and that's the hottest time to sell. So we're not getting that right now. So a couple of reasons, well, a lot more than a couple of reasons, but the biggest reasons why people aren't going to sell unless they have to. There's uncertainty in the market. What's going on with the economy? How are things going? A lot of people have a wait and see attitude. That's first and foremost. Second is people have mortgages. I think there's some staggering numbers, like 3 and 11 mortgages are under 3%, like 2.75%, and 7 out of 11 are 4% or less. That is a substantial amount of properties that are way below 4%. So there's no incentive for those people to sell. Reason there's no incentive, that if housing prices have been stable, right, so you didn't have any big drops, if you're buying a $500,000 house at a 3%, or your monthly payment is a heck of a lot different than a $500,000 house at 6.25%. At roughly where rates are in the ballpark right now. 6.3, I believe, is where they are, or 6.4, somewhere in that range, or 6.5%. We'll call somewhere right in around that range. And they are luckily going in a downtrend, which is where I was hoping, because I expected this to be a nice, robust spring market to sell as real estate investors to make good profits. That's what I was banking on. So far, it's going that way. I'm hoping it continues, and I'm hoping job layoffs and everything don't get too bad, because I am worried about that. And speaking of the devil, let's look at the jobs as well. And look at, here we go. We're going to go layoff tracker. And this is a big one. And I look at Walmart, because Walmart's a big one, major retail. So they are now laying off 200 workers. They just announced they're laying off 200 workers in Florida, New Jersey, and Pennsylvania, and Texas. So there's going to be, that's 5 plants, laid off employees in 5 different plants. So you're starting to see it there. So that means retail's getting hit a bit, right? It's been kind of being hit. McDonald's is also cutting hundreds. McDonald's has its own issues. McDonald's prices have skyrocketed. They better wake up, or they're going to be non-existent in the future here, because their prices are off the charts, and Chick-fil-A is killing them in business. So companies like McDonald's, Burger King, Wendy's better wake up, and they better wake up quick, because it's supposed to be fast food that's inexpensive. It is not inexpensive. I think I got a large fry the other day, $3.50 for a large fry. That's ridiculous. Okay, inflation did not go up that much on potatoes. So McDonald's is going to have layoffs. But another reason McDonald's may be having layoffs is they're going to go to more robotics, which means they don't need as many people working there to make the burgers, the fries, and all those things. You got a lot of software companies, right, still laying off here. Highland Software is cutting 1,000 jobs. Roku is cutting 6% of its workforce, 200 employees. Electronic Arts is cutting 6% of its workforce. You're starting to see a pretty substantial amount of these companies' workforce is being cut. Lucid Group, which is a Bay Area, San Francisco Bay electric car maker, is cutting 7,200 employees, 18% of its sales force. That's huge. Disney, this is really big. Again, this is globally, but they're cutting 3.2% of their force 220,000 people. That's across the world. Bed Bath & Beyond is cutting 1,300 employees. So you're starting to see the beginning of unemployment really going in the wrong direction. And this is a leading indicator. Unemployment is the number one leading indicator for real estate investors to look at, because as these people lose jobs, that's less potential buyers for you. If they don't make any money, they're not going to be going to be buying your properties. Depending on what price point you're at here and what market it is, this is very important, right? So this is the number one thing I look at, and that's where I'm not 100% in unison with CoreLogic. Again, CoreLogic is using the amount of inventory. They're taking a bunch of factors in, right? The demand, they're figuring interest rates are going to lower because right now it is projected that interest rates are going to be around 6.3% in Q2 of this year, which we are in now, 5.9% in the third quarter, which will be in the summertime here. And if that happens, you're going to see a nice little boost in real estate there, because it gets in the fives, it gets attractive to people. And for people that have followed me on the Virtual Investor channel on YouTube, I'm worried about the time period. I'm really worried about is after July, because that's generally when demand starts to fall in July in real estate. And August, especially September, October, November, December, those are your slow months where sales drop, where inventory increases, and we really kind of get a gauge of the market. And I'm feeling that we're going to be getting higher unemployment, and we're going to be seeing a lot of bad things, which would negate that potential 3.7 to 4.6% increase in real estate going into next year. And again, I don't know whether CoreLogic takes unemployment or gauges potential unemployment. I don't think it would take that into consideration. It's looking at current market demand. It's looking at current employment numbers and projecting forward. Don't know whether it's projecting recession, which I feel we're already in, but we're going to be heading into a little bit of a deeper one, and hopefully not too much worse. But I do have fears that we're going in the wrong direction here. But you can see, look at all these. This Forbes, this was just out today here, just a few hours ago, all these jobs that are being cut. Big time important stuff to know. All right, let's go to Redfin. Redfin has some really great data. I like Redfin a lot. You guys know that I like Altos Research and Redfin. So Redfin, if you look at year over year, let's look at median days in the market. Last year, February, just peak demand, right? 25 days on the market was their average, which is extraordinarily low. Now it's 52, which is still very, very low considering normal terms. I think normal is somewhere around 80, 90 some days on the market, or 78 days on the market. But that's an increase that more than doubled, up 27 days from last year to this year. And mortgage interest rates are a big part of it, and low inventory is a part of it as well. So then if we go to the median sales price, $391,000 last February to $387,000 in this February. And this number is kind of surprising, because if you go to the box below here, mortgage rates were 3.9% last March, and they're 6.6% this past March. So you're talking about 2.7% higher, and you're almost the same price. The median price only dropped 1%. That means there is a lot of demand. There's still a lot of demand. And as you know, there's more buyers out there than there are properties available, and new construction cannot keep up with the demand that we're having right now. So let's look at average sale to list price. And last year, everything was going over list. Everything was being bid up. So you got 101.3%. You knew that wasn't going to be able to continue. That trend could not continue. Now, still high, 98.2% of list. It's still very good, but down 3% year over year. New listings last year, this was the time where 508,000, that's where you get growing inventory in February. And this year, only 391,000. Big difference, down 23% year over year, new inventory. Number of homes for sale, 638,000 last February. This February, 851,000. So it's up 33%, but last year was a record low. So that's to be expected. Homes sold, Last February, 418,000. This February, just about 325,000. It's down 22.3%, which is big. And interest rate to me is the number one factor there. Waive contingencies, very important. Obviously, in a seller's market, 15% of people are waiving contingencies. And this February, it's only 8%. So that's down 7%. So very good data there. Very helpful data. All right, now let's go to the cities where the markets are growing the fastest. This is an interesting one. That Farmington, I think it was Farmington, New Mexico, was where it was growing at the fastest rate, which is, it's a smaller market. It's definitely a smaller market. If I go to the article I was looking at earlier, investors are purchasing more single-family homes than ever. Okay, and a lot of that's ma and pa. But let's look at this. So you got the small mom and pop that just buy 1 to 9 properties. That's 49% of the buyers. Then you got the people who buy between 11 and 100, and I fall into this number here, and that's 33%. And then you get your bigger, like hedge funds or your big investors out there who are just doing multiple numbers between 101 and 1,000 per year. And then you got the big hedge funds that are doing 1,000 plus per year. Again, not a lot, 11% and 8%, only 19% between those two. Really, it's mostly small mom and pop and your average good real estate investor out there. But they're buying the single family housing. That's big. And that's going to continue. I expect that trend to continue for a long time here. Now let's talk about some of the other, let's go to mortgage rates. Let's just take a look at that real quick. Falling mortgage rates set to boost home sales by more than 200,000. And this is the kind of data that CoreLogic was seeing here. And again, falling mortgage rates is great for the market. The timing couldn't be better here that we're in early April. I think April 11th today is. So at the time of this recording. So we're in a good time period for mortgage rates below because we're going to be coming into April, May, June, which is peak buying seasons. Really, it leaks in a little bit in July too, but people want to buy and have a place by before school starts, right? So you want to get it by August, depending on where you are. Here in Florida, we start August 10th. Other parts of the country start earlier too, but places in the Northeast and other parts start after Labor Day. So a lot of people just want to have everything situated and move either July or August. So that's why I see so many home sales take place March, April, May, June, July. So those are your 5 biggest months that you're going to have right there. So, but declining mortgage rates, increasing it by 200,000, that's pretty impressive. So that if that happens, it's kind of something I do feel is going to happen. You'll have a nice boost. Here we go. They talk about the 30-year mortgage rates. On average, they feel that they're going to decline to 6.3% in the second quarter, which I said earlier, 5.9% in the third quarter. They didn't give fourth quarter estimates, but I would imagine it'd be somewhere in that upper 5s, lower 6s, or even maybe middle 5s. And I'm hoping for middle 5s because I got some properties I would like to refinance. About 40% of U.S. homes go under contract in the April to June periods. Again, I was just talking about that April, May, June. That's 3 months. 40% of the housing that is sold in a year is sold during April to June. That's why as an investor, you're trying to push it out during that time because that is your peak. That's where you're going to get the most for your money. You're going to have the most demand, most chance for high bidding wars, which we've run into on multiple properties here. One Columbus, Ohio, which I had 6 bids on that one, 6 people bidding it up, and it went well beyond asking price on that. So right now we're getting into the middle of the peak buying season, and with mortgage rates going down, that is indeed a very good sign. Very, very good sign. All right, we're going to stop sharing now, and we're just going to talk a little bit about where things are heading. And why, some of the headwinds that we're facing as real estate investors and some of the tailwinds. Obviously, your biggest headwind is going to be unemployment data, right? Unemployment going up. Another headwind would be if mortgage rates went up. Those are 2 big headwinds. The other headwind would be if you suddenly had an increase in inventory. We don't show any signs of an increase in inventory at all this year moving forward. Nothing in the data is saying that. We don't see any signs of mortgage rates really skyrocketing for any reason in particular. Things could change, right? We could have an economic bombshell put out there that could really change it and hurt the bond market and really shoot mortgage rates up or down further. We just don't know. Remember, during uncertain economic times, you usually have the flight to quality where people go to bonds, and that would usually help lower mortgage rates if they're buying a 10-year treasury bond. But usually that's the 30-year that they buy with those. But judging that the mortgage rates look like they're going down, inventory stable to down throughout this year, we got some good headwinds, which means pricing should stay stable, shouldn't go down too much, and may even rise like CoreLogic believes it will. Let's talk about what other factor could push unemployment higher, and in my eyes. And we're seeing the advancement. We started seeing it late in the year last year, November, December. AI, artificial intelligence coming out. How many jobs will that take? Because now, if a newspaper could just have AI write articles, what do they need writers for? How many thousands of writers are there out there? Hundreds of thousands that could get laid off for AI. So a big factor. Plus, as innovation continues, you're going to have more machines taking over jobs at fast food places. And we're seeing these different things in restaurants where you're seeing food being delivered by a robot or a machine bringing all the food over. You're going to see more and more of this. And that's more and more job losses, which is why you're hearing more and more from people on UBI, Universal Basic Income, which is coming. It's just a matter of when. And it's not necessarily a horrible thing when you look at it. Initially, back years ago when I've heard about it, but it's ridiculous, right? People don't want to work, but there may be that many less jobs. But I somehow believe, I come from the belief that as those jobs are being taken up, there's going to be other opportunities for other jobs, more entrepreneurial jobs for people to go out there and do. There's always going to be a void that needs to be filled. And if you can go in there and separate yourself from other people, you're going to be able to fill that void and be hugely successful doing it. Real estate is always going to be there. There's always going to be a demand. And the reason I think it could continue going up for the next decade or so, even if it stays fairly stable, but a nice upward trend, is because you have so many hedge funds buying up properties. You have so many investors buying up properties, keeping these rentals because rentals are in high demand and rental prices keep going up, that you're going to have so few properties for your average person who wants to live in a home, buy it and own it themselves to buy, that prices can do nothing but go up. And it has to do with the old Klaus Schwab World Economic Forum, you'll own nothing and you'll be happy. Well, that's not true. People do not want to own nothing, and they're not going to be happy if they don't own anything. Nobody wants to sit there and be the renter and watch somebody else making money. So you'll own nothing and you'll be happy is wrong. You'll own nothing potentially, but you're not going to be happy probably, unless there's other things you could do which are making you happy in some other way. But definitely not trending in the right direction there. That is going in the wrong direction. So I don't like where we're heading there. So the role of AI could really lead to a lot of job loss in different businesses, different sectors. Potentially, though, maybe it brings up some new kind of job that we don't even know about at this point. Who knows? They always talked about the Mac machines or, the ATM machines taking away all the teller jobs. The ATM machines have been around since the 70s. There's still a lot of tellers out there. Eventually, we will not have tellers because we will not have the need for banks the way we have it now. And you see so many banks closing. I see so many Wells Fargo branches closing, many different bank branches closing because there's just not going to be the need. You'll be able to do everything through your phone. Everything's going to be able to be done through your phone. I already do with cryptos, right? There's so many things I could do with my phone that I don't need a bank. I'd much rather send something digitally, like a crypto, than send a wire, would charge me $25, $35 per wire. And where I could pay pennies depending what I'm doing with crypto, or even digital dollars. And let's get into that next. So you're going to have the U.S. digital dollar, the banks, the central banks are going to be creating these things, and they're not good. The reason I say they're not good is because they can track everything you do. And they want that because they can control everything you do. And also they know everything you're buying. They know your patterns. They don't have to pay for marketing. these businesses will not have to pay for marketing because they know exactly what you do Monday through Sunday and what your purchases are, what your tendencies are, what you're looking at to buy. So this already happens that you're looking to buy, but they're going to be able to track everything, penalize you if they don't like what you're doing. Remember last year when in Canada, when people were giving money to the truckers, and in Canada they were freezing people's accounts and doing all kinds of crazy stuff. That can happen anywhere. And if a central bank does this, just know you aren't in control of your money, which is why I like cryptocurrency so much, like Bitcoin, many other cryptocurrencies, because totally decentralized. You control it. They can't seize it. You have it in your cold storage wallet. Nothing they can do to get that from you. And very soon, I'm hoping in the next 5 to 10 years, we're going to have a major convergence of crypto and real estate. It's already started, but we are in the very, very infant stages. Go back to 2009 when Bitcoin was created. It didn't become really that mainstream until about 2017. So you're talking about 8 years it took. So I'm thinking another 5 to 8 years, maybe 10 years before it becomes more mainstream on a real estate side, and where mortgages are done with cryptos, where you can fund a rental property through as an NFT in crypto. You can already do that, believe it or not, but we're to become mainstream and much easier for anybody to do. And wouldn't it be great if you didn't have to go to the bank anymore, if you could just raise your funds that way, and people can have partial ownership in your rental and get benefits if you wanted to do that, or just get a nice rate of return on your mortgage. So lots of opportunities coming out there in the digital space, decentralized, the DeFi space, which I love, and regular cryptos. Nothing to do with the global central bank digital currencies, the global GBDCs. I don't like them at all. Don't want anything to do with the global bank digital currencies. So that's just me. It's my preference. I want to control my money. I don't want anybody to have control of it. But enough about the digital currencies for now. Let's talk about some of the tailwinds we have in the real estate market. And there's quite a few, and I've already mentioned them. So low inventory, 410,000 of homes currently available, with no sign of any kind of a big increase in inventory happening. We have falling mortgage rates. They're not plummeting, but they're steady to falling, which is good. And the right time of year to have this. They're coming in the spring market. There's more buying demand than there is properties available, which is going to keep prices stabilized, right? Stabilized and maybe even increasing. We don't have enough new construction to meet demand. So that's another thing. And why don't we have enough new construction? Well, there's a lot of factors. The cost of financing is one. The cost of the mortgage, right? And less buyers for that at that higher mortgage rate, because the higher cost you have to charge for new construction hurts. Profits are all coming down. Labor costs are up. Material costs are up. The time it takes to build is up because of supply chain issues. So a lot of factors that have gone there is why new construction is down. And it becomes very unaffordable to make entry-level homes. And entry-level homes are what we need. That's the big area we are missing. I'm looking, hopefully, here in the future, this year, next year, I'd love to get into some of the smaller homes, which would be your entry-level homes, whether it's a 2-1, 3-1, but small, very energy efficient, and built strong, can withstand, like hopefully here in Florida where I am, that it can withstand a hurricane, but also strong, stable, and affordable is what I'm hoping it would be. Because I like to make some rentals this way, and I like to make some that I could sell. And it'd be great if I could make them affordable, so your average Joe and Jane home buyer can buy them. All right. So rents are strong and continue to be strong. And rents and interest rates go hand in hand. So as interest rates drop, rental demand drops, because people that are renters can now afford to buy. They might meet the debt to income ratio. As mortgage rates increase, rental rates increase. They're directly correlated here. And it's not always exactly that way, but in the majority of the time, they're going to go hand in hand, because it becomes more unaffordable to buy a house than you go to rent. If renting is more affordable than buying, you go back and forth. A lot of millennials like to be they do like to rent because they want to be able to go from either job to job or be able to move whenever they want to. All right, what else do we have? So we have a growing population, thanks to the Biden administration, by leaving the border wide open. So we have more people coming in. They need housing, mostly rentals, but eventually home buying. So that's another factor that's happening here as well. And of course, we have the just overall demand of the market. And we have generations like Gen Z wanting to buy. We have more millennials wanting to buy at this point. So we have a lot of tailwinds, which are really helping us. And I think we have more currently right now. We have more tailwinds than headwinds. But I want to tell you why I'm personally more worried about the end of the year here. As we get to past July and into August, September, and into 2024, I'm a little bit bearish there. I do feel there's going to be a lot more unemployment than we think. And with that, it's going to hurt the market, right? Because you're going to have less buyers who can go out there and buy those properties. So I'm a little bit more bearish than core logic. However, I do think year over year, the numbers could be close to that. I do expect them to be at least flat or up, maybe 1%, maybe 2%. I'm not sure if we get to the 3.7 to 4.6. I hope we do, because that would be great for what I own. And if rates drop into the fives, it'd be great for me refinancing these properties, because now I can cash flow them even better. And I'm going to kind of leave you guys with this point and this podcast here, talking about what my strategy is. So my strategy, I'm going to continue to do wholesaling. I want to do more wholesaling than fix and flips, because I'm uncertain about the market. I've been doing a lot of the fixes right now, leading into the spring market. But now I really want to reduce that. Once we get beyond the spring market, I really want to start wholesaling 70, 80% of my properties and keeping some. I want to keep some more rentals. I want to keep more and more and more rentals. If rates continue to go in the downward direction, which I like, I hope, I'm going to acquire more and more rentals, because more and more of them are going to cash flow. So that's what I'm looking for. So I'm looking for really good rental deals, because you need to buy and hold if you want to create a long-term wealth, right? That's how it's about how many properties you keep. There's going to be ones you don't want to, but the majority of the ones that you buy that were rentals, you're going to want to hang on to them. Sell the dogs when the market shifts, but keep as many as you can. Create as much passive income, because it's taxed at a very favorable rate for you compared to fix and flips, which is the short-term capital gains. It's definitely more tax advantageous for you to keep more properties, because you can do accelerated depreciation still. You can write off the taxes, insurance, maintenance, all these different things. And it's super important to do that and grow that. And I've done that a couple of times, and then I've sold them when markets have peaked. But now I want to get a few that are more long-term. I have my 12 unit in Casper, Wyoming. I'm renovating a 5 unit right now. I have some singles, one single in Moorcroft, a couple in Texas, and I want to continue to build more and more and more. There's a couple I'm getting in Tennessee, one I'm working on rehabbing now, one I'm closing later this week in Gatlinburg, that I'm looking to potentially keep as a long-term hold, potentially an Airbnb as well. So that's kind of where I'm heading here. And I want to give you guys my thoughts on that, with what's going on in the market of 2023 and where things are heading in 2024. And what my thoughts are, what some of the so-called experts think, and we'll see how it goes and see how it plays out. I'm sure we're going to get plenty of wild cards along the way. Anyway, thank you all for listening, and we will catch you in the next episode.